Hello, Patrick Walchuk here, and we're going to do a financial analysis on a multi-unit residential property that sold in Ottawa in April of 2026, and we'll go through the numbers and then a little bit of interpretation as to what they might mean. So getting right into it, this is in an older residential area in Central East Ottawa, if you will, and it was a four-unit building. It was a legal four-unit building, by the way, and the property had been fire retrofit as well. I did a double check on that. So this building was listed for $3,500,000. It sold for $3,350,000. The scheduled rental income, as per the MLS information, was $232,000, and the effective rental income, when we deduct 3% for vacancy and bad debt, brings us down to, call it, $225,000. The operating expenses, $38,000, and we factor in 10% for maintenance and management. The total operating expenses were $60,500, and that gives us a net operating income of $165,000. So let's see what the magic number is in terms of a cap rate. 4.92%. That surprises me a little bit. I thought it would have been a tad higher, you know, like somewhere over 5.25, 5.5 kind of thing. Anyhow, that's what the numbers say. The operating expense ratio on it, incredibly low, actually. Now, it was a purpose-built building, but anyhow, the operating expenses were 27%. I would have expected 35 maybe, if it's in pretty good shape. It sold for 15 times the gross, 20 times the net. And what we do is we take a look at how much of a down payment was required in order for this to be cash flow positive. And again, CMHC requires a minimum of 20% down if it's going to be a non-owner occupied property. So in this case here, it required 28% down in order to cash flow positive, and that 28% is the equivalent of $938,000 as down payment. We used a mortgage rate of 4.5%. That gives us an annual debt service of $163,000, we'll call it 163, and for that amount of money as a down payment, the cash flow on it is $1,840, which is an ROI of 0.20%. Thank you for watching.